Hey, welcome to my mini lecture on adjusting and accrual entries. And this YouTube video is a companion to the Google Documents spreadsheet that we're going to be working with. You can't just watch the video, you really need to download the documents, work these over, and practice with them, put in some of your own journal entries. That's the only way to learn accounting, is to practice, practice, practice. So if you've watched our Introduction to Financial Accounting, the preparation of the financial statements, and the journal entry videos, you're familiar with how this is set up. We have a general journal, which is how all transactions get into the company's books. Everything has to come through the general journal. Then it's posted to the general ledger. From the general ledger, we bring the balances over to a trial balance. And the trial balance, which balances in this case, rolls forward to the income statement, statement of retained earnings, and the balance sheet. So let's step back. We have already produced financial statements for Lizzie Inc. And now we've figured out that Lizzie hadn't told us about all the transactions. So we need to make sure that we're applying the matching principle, which all the matching principle is doing is making sure that we record expenses in the same period as the revenue that they help generate. So if you have a piece of equipment, for example, you're using that to help generate revenue. Lizzie was using that to generate revenue. We need to record the depreciation expense in the period in which it helped generate the revenue. So we have an additional 5 transactions that needed to be recorded at the end of the year because Lizzie hadn't given us all the information. We're just going to go through a couple of these so you can see how the spreadsheet works. And then what I want you to do is go download the document from Google Documents, set up your own general journal and general ledger, put through some more transactions, and post those all the way through. We need to make sure that you can analyze a transaction, understand how that's going to affect the financial statements. With adjusting entries, just like normal journal entries, if you are not familiar with your memorization, which kind of the account types and whether they're debits or credits, you've really got to work on that memorization. So let's dive right in. This is accrual calculations. This is the second tab in the spreadsheet after general journal. And the first one is our inventory periodic adjustment. At the end of the period, and a lot of you have done this with jobs, you go and count everything at the end of the year. Well, Lizzie performed a physical count of her inventory, and she figured out that she didn't have any more inventory. Well, the balance was $18,839, but it should have been 0. So what we needed to do is credit inventory, reduce that by $18,839 and bring it down to 0. The debit side of that journal entry goes to, there's number 9, cost of goods sold. Those were all that was expensing of the inventory. Okay, next transaction. Interest payable. We recall Lizzie had a 2-year note with 10% interest, and she took that out. She sold that note on July 1st. So she's got 6 months in 2009 she needs to accrue the interest. We all are familiar with principal times rate times time. So this is a $20,000 note times 10% interest times 6 out of 12 months gives us $1,000. Well, that is increasing interest expense, and it's also increasing interest payable. On the journal, I actually recorded that to accounts payable, and any current liability, we'd be happy with posting that. We could have set up a new account for interest payable. We didn't. We just hit it to accounts payable here. Next, let's look at depreciation. And we had a piece of equipment that we bought halfway through the year, or Lizzie bought halfway through the year. And we calculated the straight line depreciation, which I'm not going to get into that much in this video, but the calculation is on the spreadsheet. What you need to concentrate on is that we just need to record half a year of depreciation expense because some of that equipment was used up. So journal entry number 11 records the depreciation expense for the 6 months ended December 31st, 2009. Let's look at journal entry number 12. And recall Lizzie had prepaid insurance. She bought an insurance policy halfway through the year for $750. Well, that insurance policy gave her the peace of mind to go out and earn money, but half of that has been used up. So if we look at that from a balance sheet approach, Here's the prepaid expense T account. And this isn't the general ledger. This is just us scratching a little T account on the back of an envelope, little scratch paper. We see that the balance is $750, but we know that the balance should be half of that, $375. So what our journal entry is going to be is a credit of $375, which brings the balance to $375. The other side of that transaction then is insurance expense. We need a debit to balance out the transaction. Last transaction, Lizzie's not that responsible. She's a cat. I guess responsible enough to have her own company, but she recorded some sales. She sold some product that she didn't send out an invoice on. So we, the accountants, did the good work. We actually sent out an invoice after year end, but she had sold the product before the end of the year. Therefore, we need to record one more transaction for increasing the sales by crediting sales and increasing accounts receivable. Even though we hadn't sent out a bill yet, people owed us money. You'll notice all of those flow through to the general ledger, which then flow through to the account listing. This is a little bit different than what we used with just the normal journal entries because we had a few new accounts. All of those balances from the general ledger flowed through to the trial balance and gave us a new trial balance that balanced to $49,669. This then flowed through. Each of those accounts on the trial balance was used on one of these three financial statements: income statement, statement of retained earnings, and balance sheet. This, like I've told you before, you cannot learn this stuff just by watching a video on YouTube. You've got to practice and get better at it. You need to have a very good understanding. You need to be able to identify these account types, understand which of the 6 account types they fall into and whether their normal account balance is a debit or credit, and how you increase or decrease them. I want you to earn an A in Accounting 1. The only way to do it is to practice this. What I'd like you to do is create some more of your own adjusting entries that you think Lizzie may have needed to record. For example, what if she needed to record her utilities expense for the end of December? She hadn't received a bill yet, so she didn't record anything, but she still used electricity in the month. Good luck, and get an A in Accounting 1.